Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Phil Mackintosh, chief economist at Nasdaq, to discuss if the global bond market agrees with Federal Reserve Chair Jay Powell. Phil, we can see that growth stocks are facing headwinds as rates rise. Let's discuss what's happening there and why bonds may disagree with Powell.
Yeah, I mean, we've been talking about the fact that the bond markets, the rates have been increasing for the last 6 months. And yesterday, Powell was pretty determined to say nothing about tapering, to say nothing about taking the foot off the gas in terms of getting through coronavirus, getting all of the employment back to where it should be, including the sectors we've been talking about that have been most hit. So not just looking at top line unemployment numbers, but making sure that all those really badly affected sectors are back to pretty much normal rates of employment. It's kind of interesting because the equity markets the last few days had been sort of, discounting growth, which we'd expect when interest rates are going up. And as Powell started to talk, we saw that turn around. So the Fed's got a fine balancing act to do when we're seeing some signs of inflation where demand is, and we know there's a huge stimulus coming. Lots of economists are talking about upside risk to inflation numbers, and the Fed's going to have to work out how they balance out what the bond markets think should be happening and what actually they are able to deliver.
So why do you think that the bond market is disagreeing with Powell based on what you've seen from the start of the year?
I mean, there is we've got pretty negative real rates right now. So the rate of interest that we're earning on a treasury bill is well below the rate of inflation. That kind of has to normalize. In a normal market, you'd expect to at least earn back the amount of inflation on your bond holdings. So there's that aspect, but there's also just the aspect that with this much money in the system, when everybody gets vaccinated, there's going to be a lot of demand. There's going to be a lot of demand for services. And we're already seeing the demand for retail sales is higher than pre-COVID. A lot of manufacturing demand is higher than pre-COVID. We're seeing commodity prices rise. We're seeing input prices rise for a lot of manufacturing. Where there is demand, there is inflation now. But what we haven't seen in the services sector is any demand. So what we don't know is when we see vaccines come through, will that demand translate into prices rising because there's supply constraints? Or will we actually somehow manage to keep inflation at around about the 2% target level? There's other deflationary pressures as well, but I think the bond market thinks we'll be getting back to normal faster than the Fed does. And the Fed has other things to worry about. I mean, if interest rates climb too fast, equities might sell off, but also the cost of interest finance on this huge amount of debt, the fiscal spending that we're releasing, goes up as well. And that's going to be more problematic for future budgets. So there's a lot of different things to consider. There's some risks in the market coming out 2-3 years.
But one area of the economy that continues to thrive is housing, of course, especially single family homes.
Yeah, that's one area where there's heaps of demand. I mean, we see completely different results for single family homes where you can obviously socially distance from your neighbors, and multifamily homes where you can't. And a lot of people have been trying to move to the suburbs and trying to move into houses that are single family. You can see that with a big spike in the Case-Shiller home index while we've had a recession, which is completely different to how normally house prices and recessions work. And also not just people buying houses, but people buying home building products. So Lowe's and Home Depot this quarter have had great results. And that's because people are renovating their house. They're putting home offices in, compared to department stores still really struggling with their sales levels.
And finally, explain to us what financial transaction taxes are and how that could impact traders in the market.
Yeah, so obviously with the government's worried about their revenues because everybody's working from home and getting stimulus checks rather than wages, there's a lot of governments looking for other ways to raise revenues. And around the world, there's a couple of countries that have financial transactions taxes. So it's looked at as a little tiny tax every time someone trades. What's interesting is if you look at the research into it and the times that they've been implemented, you add a tax to trading and you actually increase the cost and decrease the return of investments. And so the market tends to discount those investments, increases the cost of capital, liquidity drops, spreads widen. Like, it all makes sense for someone that's living in the markets and trying to make money without paying too much out in taxes. But it's interesting because in Hong Kong, they just increased their transactions tax and overnight the market fell. So, it's one of those things that's out there at the moment. It sounds like an easy win. There's trillions of dollars of financial transactions every day. Let's just take a little tiny piece of each of them. But it's one of those taxes that actually might have more unintended consequences than we think, because all of our pension assets will devalue. And a lot of people will probably lose jobs, which means that the income that they spend on restaurants and downstream jobs as well, and taxes for the states where finance is a big industry, will be affected too. So it actually historically decreases trading quite significantly. The taxes you expect to earn don't get earned because all of a sudden all those trades aren't worth doing. And there's a lot of countries that have implemented these only to wind them back out not much longer later, because it's not the panacea that it sounds like, and it's actually pretty detrimental to a lot of local economies.
Appreciate the insight, Phil. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.